Okay, let's just dive right in. We are smack in the middle of one of the biggest contradictions in modern financial history. I mean, on one hand, you have global chaos. On the other, markets are absolutely euphoric. This is the 2026 paradox, where it feels like the old rules have just been completely thrown out the window.
I want you to just look at this number. According to the International Energy Agency, 10.1 million barrels of oil per day just vanished from the global market in March. Now, this isn't some small pipeline issue. This is, by every measure, the largest single oil supply shock we have ever seen.
And why did that happen? Well, this is why. The Strait of Hormuz, the planet's single most critical choke point for energy, is effectively shut down. We're talking about a fifth of the entire world's oil supply that flows through there. It's a full-on blockade, and it has brought a huge part of global trade to a grinding halt. So you'd think with that kind of chaos, markets would be in a total freefall, right? But they're not. You've got major players like Morgan Stanley actually targeting 7,500 for the S&P 500 by the end of the year. This isn't just a little bounce. They're forecasting a roaring bull market in the middle of a massive global crisis. And it's not just stocks. Look at gold. The classic safe haven asset is also going parabolic, smashing past $4,800 an ounce. It's like the entire market is betting on maximum risk and maximum safety at the exact same time.
Which brings us to the big question, the central mystery we're going to unpack right now. How? How can you have a paralyzed global supply chain and at the same time record-high stock targets and surging gold? It makes no sense, and yet here we are. So let's figure out what's really going on.
But really quick, our standard disclaimer. Remember, all the data we're talking about today is for informational and educational purposes only. It is not financial advice. And of course, past performance is never a guarantee of future results.
Okay, so the key to this whole paradox starts right here. The reason nothing makes sense is because in 2026, there isn't one single global story anymore. The world economy has literally fractured into separate and often competing realities.
And this slide just perfectly captures that split. Think of it as a tale of two economies. Over here, you've got the US engine, just humming along, supercharged by this incredible AI investment cycle. You've got Goldman Sachs calling for a solid 2.8% GDP growth, and S&P 500 earnings, a staggering 22% growth. But then, in the other corner, it's a totally different story. China is stuck fighting deflation. The UK is caught in a stagflation trap, where growth is stagnant but inflation is still high, thanks to the energy crisis, pushing it to 3.3%. And their central banks, they're completely paralyzed, caught between these two opposing forces. And just look at the raw data. This isn't just some theory. You can see it right here in the forecasts. The US is clearly outperforming. China's got a decent headline number, but the real story is their deflation problem. And the Eurozone and the UK, they're barely growing, totally exposed to this energy crisis. It's a classic K-shaped world, where the winners and losers are heading in completely opposite directions. So you've got this massive divergence, and central banks are trapped right in the middle. But you know what? The data, it leaves breadcrumbs. If you want to see how to follow those breadcrumbs and get ahead of the big institutional money shifts before the Fed makes its next move, you should probably hit subscribe, because we track this stuff daily. All right, now let's circle back to that other piece of the puzzle we talked about, gold. Because it turns out, gold's really strange behavior right now is the key that unlocks this whole mystery. I love this quote from HSBC because it gets right to the point. Gold is behaving more like a risk asset. Think about that. That's weird. During a crisis, gold is supposed to be the boring, stable safe haven. The fact that it's jumping around like a tech stock tells you something much, much bigger is happening under the surface. And that something bigger has a name: De-Dollarization. And listen, this isn't just some buzzword you hear online. This is a very real, accelerating global trend where central banks all over the world are actively reducing how much they rely on the US dollar, and instead, they're systematically buying up physical gold to hold as their primary reserve. And the scale of this is just mind-blowing. We're talking about central banks buying over 1,000 tons of gold every single year. This isn't your average investor or a hedge fund making a bet. These are nation-states making a massive strategic pivot. And that is creating a structural price floor for gold that has absolutely nothing to do with what the Fed decides to do with interest rates. So this is the main takeaway here. Gold's record-breaking price, it's not really about hedging inflation anymore. It is a direct signal of a fundamental long-term shift away from the US dollar as the world's go-to currency. That's the real story playing out right now.
Okay, so if the world is fracturing and the entire global financial system is changing, where is the smart money actually going? That brings us to our final section, the electric stack.
So here's a secret. Thriving in 2026 isn't about trying to outsmart everyone and guess what the Fed's going to do next. Like we've seen, the central banks are paralyzed. They're stuck between a rock and a hard place. The old playbook of just watch the Fed, it's broken. It's obsolete.
So instead, the big institutional money is pivoting. It's flowing into what people are calling the electric stack. And what is that? It's the real physical stuff that powers our modern world. AI data centers, massive logistics and warehousing facilities, advanced factories for things like semiconductors and batteries. Basically, the entire digital and electric backbone of the new economy. This is where capital is hiding for what they see as future-proof returns.
And the numbers back this up completely. This whole thing is being fueled by the AI investment boom. We're looking at a 58% year-over-year growth in capital spending on AI. And that massive fire hose of cash is directly fueling corporate profits, powering that 22% earnings growth we saw earlier. See, this isn't a guess. It's a real, tangible investment cycle creating actual value, completely separate from all the geopolitical chaos. So the big question is, how do you actually invest in this electric stack? Well, we're talking about very specific companies, these real estate investment trusts, or REITs, that own the actual data centers and warehouses that are powering this whole revolution. And we found the ones that are basically immune to all the debt sloshing around in the system. And that is exactly what we're breaking down next.